Hi everyone, the world woke up to a new reality on February 28th, 2026. It was not just the flash of Iranian missiles over Israeli skies that shocked global observers, but the nature of the payload. Surprised, reports of a dancing warhead, a maneuverable, cluster-tipped ballistic missile that evaded the vaunted Iron Dome, signaled a shift from precision strikes to a strategy of saturation and devastation. 16 days later, the war between Iran and the combined forces of the United States and Israel is no longer a question of territorial integrity, but of global economic stability. Size. While the death toll mounts and cities burn, a parallel crisis is unfolding in the world's financial capillaries, supply chains, and breadbaskets. The initial assumption by Western planners was for a short, decisive campaign. That assumption has been shattered. We are now witnessing the painful confirmation that you cannot confine a war of this magnitude to the battlefield. The economic shockwaves are rippling outward, redrawing the map of global finance, trade, and human welfare. To understand the depth of this crisis, we must look beyond the bomb craters and toward the three fundamental pillars of the global economy now under direct assault: the energy supply, the food system, and the stability of sovereign wealth. The most immediate and violent economic tremor is emanating from the Strait of Hormuz. This narrow maritime corridor between Iran and the Arabian Peninsula is the world's most critical energy artery, carrying nearly 1/5 of global oil production and a quarter of the world's liquefied natural gas. For years, it has been a latent geopolitical risk. Today, it is a closed war zone. Iran has formally declared the strait closed to nations it considers unfriendly. And unlike past skirmishes, Tehran has the military weight to enforce it. The Islamic Revolutionary Guard Corps has claimed control of the waterway, and at least 14 vessels attempting to navigate the passage have sustained serious damage. Insurers, spooked by the attacks, have either canceled coverage or hiked premiums by historic margins, creating a de facto blockade even for ships willing to take the risk. The arithmetic of this closure is brutal. Before the conflict, Brent crude hovered around $80 per barrel. As of today, it has surged past $103, and unlike previous spikes that were driven by speculation, this one is driven by actual supply destruction. Production stoppages have cascaded from Qatar to Iraq, and exports have ground to a halt. S&P Global has already raised its price assumptions by $5 for the remainder of the year, but private analysts warn this is conservative. If the strait remains closed for another month, let alone until September, as some defense analysts now project, we are looking at $200 oil. This is not just an inconvenience at the pump. For the United States, which has positioned itself as an energy exporter, it presents a political paradox. While American energy firms might see short-term windfalls, the Trump administration faces a ticking clock. Persistent high energy prices threaten the Republican agenda heading into the midterm elections. More critically, the cost of the war itself is staggering. Estimates from within the U.S. Congress suggest the daily military operations, the 200 jets, the 2 aircraft carriers, the relentless bombardment, are exceeding $1 billion per day. This creates a pressure cooker in Washington. The longer the war lasts, the more expensive it becomes. Yet the need to justify that expense requires a decisive victory that remains elusive. If the energy shock were an isolated event, economies might absorb it. But it is not. The war has created a feedback loop between energy and food that economists have dreaded for decades. We are witnessing the birth of a food-energy nexus crisis. The Gulf region is not just an oil well. It is a chemical plant for the world. Roughly one-third of the world's seaborne fertilizer trade passes through the Strait of Hormuz. Natural gas is the essential feedstock for nitrogen fertilizers, and with gas shipments halted, production is stalling. Meanwhile, Gulf states account for one-fifth of the world's phosphate fertilizer output and a quarter of the global sulfur supply needed to process it. The timing could not be worse. Across the Northern Hemisphere, from the farmlands of Europe to the breadbaskets of North America, March is the month farmers purchase fertilizer for spring application. With supplies blocked and prices spiking roughly 30% since the conflict began, growers face a terrible choice: pay unaffordable prices, reduce usage and accept lower yields, or switch to less input-intensive crops. This decision, made on millions of farms today, will translate into empty shelves and empty plates 6 months from now. This crisis is already manifesting in the supply chain. BASF, the chemical giant, has announced price increases of up to 20% for core plastic additives, materials used in everything from packaging to water pipes. Higher fuel prices are pushing shipping costs up, and those costs feed directly into supermarket prices. The World Food Program has issued a stark warning. Extended shipping routes and port congestion are jeopardizing their ability to reach vulnerable populations. In Lebanon, already grappling with economic collapse, internal displacement is spiking among populations that were already food insecure. For developing nations, this is existential. Countries like Egypt, Sudan, and Pakistan, which rely on fertilizer imports and are already burdened by debt, are facing a wave of imported inflation that their currencies and central banks cannot manage. This war is transferring massive amounts of wealth from energy-importing poor nations to energy-exporting rich ones, redrawing the map of global poverty in real time. On the ground in the war zone, the economies of the combatants are being hollowed out, but at vastly different speeds. For Israel, this is a war of economic attrition it never budgeted for. The Israeli Finance Ministry has released a sobering assessment. Under current red alert restrictions, with schools closed, workers confined to shelters, and hundreds of thousands of reservists called up, the economy is losing 9.4 billion shekels, $2.93 billion, per week. To put that in perspective, that is a rate of loss that could erase 1% of quarterly GDP in a matter of weeks. The shekel, which typically rebounds after conflicts, is under severe pressure. JP Morgan has warned that prolonged hostilities could have a lasting impact, especially if Hezbollah enters the fray in a more significant way. The 2026 defense budget has ballooned to 121 billion shekels, and with the fiscal deficit already exceeding 3.9%, the cost of this war will be paid by Israeli taxpayers for a generation. Iran presents a more complex picture. Western strategists hoped that the assassination of Supreme Leader Ali Khamenei in the opening days would trigger a collapse. Instead, the opposite has occurred. The political system adapted, elevating Mojtaba Khamenei, and the state has consolidated its internal cohesion. Economically, Iran is suffering. GDP is likely to fall by more than 10% if the war continues, and cities like Tehran have become ghost towns. However, Iran is betting on what analysts call the long breath strategy. Tehran understands that while its infrastructure degrades, the economic pain it inflicts through the Hormuz blockade and missile barrages is designed to be asymmetrical. The Iranian leadership is betting that the American and Israeli home fronts cannot withstand a long war of attrition. They are relying on the fact that while Iranians are accustomed to sanctions and hardship, Western economies have forgotten what sustained scarcity feels like. As the reality of a long war sets in, the global financial architecture is warping. Investors are fleeing risk. The Swiss franc, the classic safe haven, has gained 3% against the dollar this year. Gold, which was already up 22% in 2026, is attracting inflows not seen since the 2008 financial crisis. The VIX Volatility Index, Wall Street's fear gauge, has climbed by 1/3, reflecting the uncertainty. But not all assets are behaving as expected. Bitcoin, once touted as digital gold, has slumped, shedding 25% of its value over the past 2 months, proof that in a true liquidity crisis, even alternative assets get sold off for cash. Gulf stock markets, the barometer of regional confidence, are bleeding. Analysts estimate equities could fall between 3% and 5%, with the Saudi index already extending recent losses. The brand of Dubai, built on the promise of safety in a turbulent region, has been tarnished. Its international airport and coastal hotels have sustained damage, and the flight of capital from the region has begun. We are only 16 days into a war that the U.S. Central Command admitted is ahead of the game plan. But wars rarely follow game plans. What began as Operation Epic Fury, a campaign to degrade missile capabilities, has morphed into a confrontation that now threatens the global rules-based economic order. The projection that this war could drag on until September is not just a military forecast. It is an economic death sentence for some developing nations. If the Strait of Hormuz remains closed until then, the resulting energy shortages, fertilizer famine, and inflationary spiral will plunge millions into poverty. The dancing warhead that shocked the Iron Dome was not just a military innovation. It was a declaration of economic warfare. It signaled that Iran intends to make the cost of this conflict too high for the global economy to bear. And so far, the math is on their side. The question lingering over Washington, Jerusalem, and every central bank from Tokyo to Frankfurt is simple. How much economic pain is the world willing to endure to win a war that no one knows how to end?